$79. If you blinked, you missed it. If you panicked, you lost it. And if you're watching this right now, you are likely suffering from financial whiplash. We just witnessed one of the most violent, high-frequency reversals in the history of the silver market. In less than 48 hours, silver crashed to a sickening low of 65, a level that terrified the retail public and liquidated the leveraged longs. And then, without a single headline to justify it, it turned around and rocketed 22% straight up. That is a 22% gain in the time it takes most people to realize they made a mistake. Welcome back to the Prosper Path. Today, we are not celebrating, we are investigating. Because a move this fast, this violent, and this vertical usually signals one of two things. Either we just saw the capitulation bottom, the absolute point of maximum fear where the weak hands handed their wealth to the strong hands, or we are staring at the most dangerous pattern in finance, the dead cat bounce. Is this the start of the run to triple digits, or is this a bull trap designed to suck you back in before the real crash to 50? This is the question that decides your financial future. And to answer it, we have to ignore the copycats who are currently deleting their bearish tweets from yesterday and rewriting them as bullish forecasts today. They chase the green candles, we chase the liquidity data. Here is the reality of what just happened. At $65, the relative strength index, RSI, on the 4-hour chart hit levels we haven't seen since the 2020 crash. The market was mathematically broken. The algorithms, the high-frequency trading bots that run 90% of this market, were programmed to buy that level automatically. This wasn't a change in fundamentals. This was a technical snapback. When you stretch a rubber band until it's about to snap and then let go, it doesn't just go back to the middle, it flies to the other side. That is what we are seeing. The shorts who piled in at the bottom got squeezed. The short squeeze forced them to buy back their positions to cover their losses, which added fuel to the fire. But here's the catch. A short squeeze is artificial buying. It's not new investors entering the market. It's old gamblers exiting their bad bets. Once the shorts are covered, who's left to buy at $80? We are seeing a classic battle between market structure and physical reality. The paper market is whipping around like a rag doll because liquidity has evaporated. There are no sellers and there are no buyers, just machines hunting for stop losses. In this video, I'm going to break down the 3 critical signals that will tell us if this is a fake out or the real deal. We are going to look at the volume profile, the open interest, and the one indicator from China that never lies. Do not FOMO, fear of missing out, into this rally until you see the evidence I'm about to show you. The market is trying to trick you. It wants you to buy the top of the bounce so it can crush you again. Stay sharp. The volatility is not over. It is just getting started. To understand if this is real, you have to understand how price moves in a broken market. In a healthy bull market, price climbs like a staircase. It goes up, pulls back, builds a base, and goes up again. That is organic buying. That is real people exchanging cash for metal because they believe in the future value. But what we just saw from $65 to $79 was not a staircase. It was a teleportation. We call this a liquidity vacuum. When the price crashed to $65, it wiped out every buyer on the way down. The order book was completely empty. Then, when the sellers tried to take profit, like when the shorts decided to cover their positions, there was nobody selling to them. Think about that. The shorts have to buy to close their trade. But because everyone else was too terrified to sell at the bottom, the shorts had to bid the price up, and up, and up, just to find someone willing to give them a contract. This created a feedback loop. The higher the price went, the more shorts panicked and bought, pushing the price even higher. This is the classic definition of a short squeeze. It is violent. It is explosive. And most importantly, it is often temporary. Why? Because a short squeeze is fueled by forced buying, not conviction buying. The people buying at $70, $75, and $78 weren't buying because they wanted to own silver. They were buying because they were trapped and needed to get out. Once the last short is covered, the buying pressure evaporates instantly. And that brings us to the most dangerous technical signal on the chart right now, the volume profile. Look closely at the volume during this rally. Usually, in a real reversal, you want to see massive, sustained volume on the way up, proof that big institutions are stepping in to defend the price. But here, the volume on the way up was actually lighter than the volume on the way down. That is a divergence. It tells us that the price is rising on thin air. The algorithms, the high-frequency trading bots, saw the RSI, relative strength index, hit 30 at the $65 level. That is the mathematical signal for oversold. They automatically switched from sell to buy. They triggered this bounce mechanically. It wasn't a change in sentiment. It was a line of code executing a command. So here is the harsh truth that the moon boys won't tell you. A V-shaped recovery on low volume is often a bull trap. It lures retail traders back in, makes them feel safe, and then rolls over to test the lows again. This is the dead cat bounce scenario. However, there is one piece of evidence that contradicts this bearish view. One specific data point from the physical market that suggests this might not be a trap, but a genuine supply shock. And if this data point is accurate, then $65 wasn't just a low, it was the low for the year. We need to look at who was buying while the paper market was burning. Because while the algorithms were playing games, the whales were opening their vaults. While the Western algorithms were playing video games with the RSI, the Eastern vaults were being drained of real metal. Here is the one data point that proves this rally might be real. According to the latest data from the Shanghai Futures Exchange, SHFE, silver inventory has just collapsed to 349.9 tons. To put that into perspective, in just 2 weeks, nearly 30% of their entire stockpile has evaporated. We are seeing withdrawals of 195,000 kilograms in 15 days. This is not normal trading. This is a bank run on physical silver. Industrial giants, specifically the solar and EV manufacturers, are frantically stockpiling metal because they know what is coming. They are not looking at the chart. They are looking at their empty warehouses. And the exchange knows it. The Shanghai Gold Exchange just issued margin hike number 4 in a single week. Effective February 9th, the margin ratio for silver contracts is being hiked again to 24%. Why do you raise margins 4 times in a week? You don't do it because the market is healthy. You do it because you're terrified of a default. You do it to stop the bleeding. They're trying to make it too expensive for traders to stand for delivery, but the metal keeps leaving the building. And look at the price. While COMEX spot is fighting at $79, the Shanghai price is trading at $93. That is a $14 premium. That means the real price of silver, the price where actual physical delivery happens, is trading 17% higher than the paper price in New York. This is the physical disconnect. The paper market, COMEX, is crashing because of liquidity gaps and algorithm games. The physical market, Shanghai, is soaring because of an actual supply shortage. So, is the bounce to $79 a fakeout? If you look at the low volume, yes, it looks like a trap. But if you look at the 350 tons left in Shanghai, it looks like the start of a squeeze. When the inventory hits 0, the paper price becomes irrelevant. And at this burn rate, Shanghai has weeks, not months, left. Now, we have to make a decision. How do we trade this? Because Monday morning is going to be a war zone. So, here's the million-dollar question. What do you do on Monday morning? We are staring at a 22% vertical rally on low volume, driven by algorithms and panic covering. We have a Shanghai physical market that is bleeding inventory at a rate that guarantees a default within weeks. And we have a retail crowd that is currently feeling the dangerous mix of relief and fear of missing out, FOMO. This is the most dangerous moment in the entire cycle. Why? Because the market is trying to bait you. The dead cat bounce is designed to look exactly like a recovery. It screams the bottom is in. It paints green candles to make you feel safe. It tempts you to leverage up and chase the move, and then, just when the sentiment flips back to bullish, it pulls the rug. Here is my official verdict for the week ahead. I believe the bounce from 65 to 79 was a technical event, not a fundamental shift. The volume profile is too thin. The move was too fast. The smart money does not buy vertical spikes. They buy quiet accumulation zones. This tells me that we are likely in a fake-out rally in the short term. The odds of retesting the $70, $72 zone are extremely high. The algorithms need to verify if there are real buyers down there or if the $65 low was just a liquidity grab. Here is your battle plan for Monday. If you are a trader, do not chase this green candle. Buying after a 22% spike is financial suicide. You are providing exit liquidity for the whales who bought the bottom. Watch the $82 level. That is the line in the sand. If we can reclaim $82 and hold it with volume, then the bulls are back in control and the squeeze is on. But if we reject at $80 and start drifting lower, do not try to catch the falling knife. Let the market prove it has a floor. The safe entry is not at the bottom. It is on the confirmation of the trend. If you are a stacker, stop looking at the spot price. It is a digital illusion. Look at the premiums. Look at the availability. While the paper price whipsaws between $65 and $79, the physical dealers are struggling to source metal. If you can find physical silver at a reasonable premium, it does not matter if you buy at $75 or $68. In 5 years, when the Shanghai vault hits 0 and the industrial panic begins, nobody is going to care about a $5 difference in paper price. You are buying insurance against a currency collapse, not a lottery ticket. The bottom line, the physical reality, Shanghai draining, says we are going to triple digits. The paper market, low volume bounce, says we have one more flush coming. These two realities are at war. One of them will break this week. Do not let the volatility shake you out of your position, but do not let the FOMO trap you into a bad trade. If this analysis kept you sane during the crash, if it helped you see through the algorithm games, then hit that subscribe button. Join the Prosper Path. We are the only channel that tracks the vaults, not just the candles. And I want to know who is ready for the next wave. Drop a comment below with Prosper Path if you are holding your physical stack tight, no matter what the paper price does on Monday. Let the tourists panic, the wolves are waiting, stay liquid, stay dangerous, and never ever trust a dead cat.